Welcome to Books in Sum, your go-to for bite-sized book summaries.
The New Retirement Savings Time Bomb by Ed Slott. Ed Slott has written a helpful book on retirement planning called The New Retirement Savings Time Bomb. It describes the typical issues with savings plans and then guides you through a 5-step process to rectify the situation. The takeaway is that even modest alterations to the tax code can have a significant effect on your retirement savings by shifting the proportion of your earnings that you keep versus those that go to the federal government. If you don't keep up with how the tax laws are changing, you could end up paying more in taxes than you have to if you have any savings at all. Retirement planning in the past didn't involve IRAS or 401 seconds, so familiarity with tax law is essential. The 4 broad approaches to handling retirement savings are the book's most crucial details. You can choose to do nothing, transfer your IRA funds to a new account, take a lump sum withdrawal, or convert your IRA to a Roth IRA. It's not easy to figure out what to do with your retirement savings, but you have 4 basic options: do nothing, transfer the funds to a new IRA, take a lump sum withdrawal, or convert the funds to a Roth IRA. Leaving the retirement plan alone is the simplest course of action. The most critical information presented here concerns the various methods available for contributing to an IRA, such as rollovers and transfers between trustees. You can take a lump sum distribution from your retirement account and use the funds however you like. You must pay taxes on your Roth contributions in advance if you want to convert your savings into a Roth IRA. The main takeaway is that your IRA savings should be able to fully replace your salary in retirement, depending on your age and level of savings. Withdrawals from an individual retirement account are treated as taxable income and can be made once you reach the age of retirement. You'll need to keep your math skills sharp if you want to avoid legal trouble and make the most of your savings. Your age, the amount of your savings, and a plethora of complicated addendums and loopholes will all affect the size of your annual distribution and the amount of tax you'll owe on it. A 10% early distribution penalty will be assessed on top of your regular income tax rate if you withdraw funds from your retirement account before you turn 59 and a half. After this date, you must take an RMD from your IRA, the amount of which is determined by dividing your total IRA balance by your estimated remaining lifespan using the IRS Uniform Lifetime Table. The main takeaway is that you should set up a stretch IRA to benefit your heirs. If you were a diligent saver throughout your life, you can expect your IRA to contain a sizable amount when you pass away. The procedure for IRA stretching has changed as a result of the 2019 Secure Act. A person must have been designated as an eligible designated beneficiary, or EDB, before death. NEDBs, or non-eligible designated beneficiaries, can still withdraw money from an IRA, but they must adhere to stricter withdrawal guidelines. In the same way that EDBs and NEDBs are taxed on their income, so too are those receiving IRA distributions. Invest in a Roth IRA now to save money in the future. While contributions to a traditional IRA are not subject to taxation, withdrawals will result in taxable income. Since their inception in 1998, Roth IRAs have operated in the opposite fashion. The money you put into a Roth IRA is subject to income taxation, but the earnings on that money are exempt from taxation forever. This is a better offer for the majority of people. You can start saving in a Roth IRA by either making annual contributions or by converting an existing traditional IRA. You can't reverse the process of putting money into a Roth IRA and putting it back into a traditional IRA, and you can't take distributions until 5 years have passed since your first contribution. Investing in life insurance instead of paying estate taxes can save a lot of money. Bill Buckner had more hits than baseball greats like Mickey Mantle, Reggie Jackson, and Joe DiMaggio, making him one of the best players in baseball history. In Game 6 of the 1986 World Series, he made a mistake that ultimately cost his team the series and the championship. The same holds true for retirement funds. A simple oversight at the very end could destroy your entire legacy. The main points of this article are the many advantages of investing in life insurance instead of a traditional IRA. Unlike traditional IRAs, the proceeds from a life insurance policy are not typically subject to taxation, either as income or as part of your estate. It's worth looking into if you want to keep most of your hard-earned money for your loved ones, but it's complicated and delivers the most benefits to those with very high levels of saving. Dan Duncan passed away in a favorable year, or at least one that was good for his descendants. The estate tax had recently been repealed, so Duncan's fortunate offspring could receive the full amount of his wealth without having to pay any of it themselves. If Duncan passed away today, his children would owe the United States government around $4 billion due to the reinstatement of the estate tax. The most crucial aspects of estate planning are the portability of the $10 million tax exemption between spouses and the fact that the estate tax determines the amount of money your heirs must pay to the U.S. Treasury when they inherit your assets. Setting up an individual retirement account to distribute to an IRA trust is another way to safeguard your assets after your death. The key to a comfortable retirement and the security of your savings is catching and fixing problems before they escalate. It would be ideal if you could follow these instructions to the letter, but in the real world, mistakes are inevitable. Two of the most crucial takeaways from this text are the warning against making the same mistakes twice, and the warning against cashing out retirement funds before age 59 and a half. The process of annuitizing, however, allows you to withdraw from your IRA early without incurring any penalties. In addition, a 50% tax penalty may be applied to the amount of the RMD if it is not taken. The best way to prevent this from happening is to fix problems as soon as they are discovered. The key information here is that you can get the Form 5329 fee waived if you make a mistake. Having a seasoned tax expert on retainer is also crucial for resolving any issues that may arise. Planning ahead for retirement is essential, particularly when it comes to understanding the tax and private savings account regulations that will affect you. Furthermore, recent legislation has done away with so-called stretch IRAs, making it more difficult than ever to leave money to your heirs. Finally, state taxes are a major consideration. The majority of the rules we've examined apply at the federal level. However, state laws must also be adhered to. Many states have their own set of regulations and exceptions that can be used to your advantage if you know how to navigate the system.
We hope you found this summary helpful in your listening journey. If you're interested in diving deeper into the topic or getting your hands on the whole book, be sure to check the description below where we've included links to the book and other related products that may be useful to you. Don't forget to hit that subscribe button to stay updated on our latest book summaries. And feel free to leave a comment with any suggestions or requests for books you'd like us to cover. Thanks again for tuning in and happy listening.